Hello everyone, welcome to Crypto Basics Coach podcast. I'm Marco. I'm here to help people navigate this topic so as to benefit from the opportunity this new technology provides and not get distracted or put off from the nonsense there is out there about crypto. Anything and everything presented and discussed, whether here or in our sessions, is of an educational nature and should never be taken as financial advice. Always do your due diligence and consult professionals before making any final decisions. Episode 10. Why don't banks like you owning crypto? Welcome back, folks. Hope you've been well. While that comment is accurate, it's not the full truth. Banks not only don't like you owning crypto, they don't like you owning anything that's outside their system. And once you've had a listen to this episode, you'll understand why. At the moment, 90%, for most people 100% of what they do with their money, they get their salary, goes into the bank account, they pay their bills, they do transfers, they do international transfers from there. Typically other products that you might be using are all within the banking system. So if you're doing cash deposits, if you're doing loans, lines of credit, some financial instruments, if you're doing things a little bit more sophisticated, stocks, bonds, any financial product, managed funds, they are all within their system. They essentially make money from all the transaction fees, the service fees, the account fees, the management fees, the transfer fees. You get the picture. So when you're involved in cash in this manner or in financial products in this manner, what you're going to find is that you're part of their system. And they love that because they basically get to make money from you. And of course, we all understand that the money that you have deposited gets leveraged many more times, and they go and make money on that as well. So essentially, they've got a captive customer, and they absolutely love it. What they don't like, or rather the people that own the banking system, what they don't like is when you're outside that system, because of course, number one, you've got full control of your assets, and two, well, they're not making any fees. So naturally, they don't like it. And crypto, as you'll find out in this episode, is just one of many things that they would prefer you not to be involved in because they can't make money from it. Now, there's another aspect to this as well. Government overreach, regulatory overreach. One of the pieces of homework that you're going to be assigned later today is going to be around bail-in and bailouts. And when you understand back in 2008 when the banks were bailed out, you'll understand where a lot of money goes, and a lot of laws have changed. And the bottom line is that if you've got your investments all wrapped up in these financial products where essentially a third-party custodian is holding them, could be shares, could be managed funds, unfortunately they're not directly in your control. You are the beneficiary. In some cases, yes, you're the owner, but be very careful about who actually holds that asset, holds that investment, and what rights you have in case things go belly up. You may be surprised to find out that you're not going to be a creditor. You may be just someone who's down the bottom of the list and may never get their money or may get their money last, if there is any. So what I want to talk about today is areas where you can have a little bit more control. You can also understand why banks won't want you to be having these sorts of assets, but it's something that you should consider as part of your journey, as part of where you put some of your profits and some of your wealth in the upcoming years, or even now. If you're fortunate enough to have funds, perhaps you should diversify into some of these. So let's have a talk about, well, what sort of financial assets, investments, items are actually outside of the banking system and hence outside of their laws, their structures, and you have a bit more control. So one of the obvious ones is precious metals. If you actually have bought gold or silver, or diamonds, for example, if you actually own and hold the physical asset, whether that be in a security box somewhere or in a hole in the backyard or in a safe at home or behind. Some people may have it under the mattress. The point is that you're in physical possession. Now, of course, this takes on more responsibility. Obviously, security is clearly one of them. The other one is that you may have to look at getting certain insurance to ensure that if the house was to burn or potentially get burgled, these things are protected. Okay, so these things do come with an extra layer of responsibility, but you'll start to appreciate why they're important. The biggest factor is that it's in your possession, and also, over time, privacy. If you have everything in a super fund, or if you have everything in a managed fund, or you have everything in a bank account, it's very visible. And lots of people can go and have a look at what you have, what you own. And again, from a privacy protection perspective, that may not be what's in your best interest or your family's best interest. Next thing is art. Okay, so some people have got, whether it's pictures, it can be paintings, it could be sculptures, but there's art is something that is physical that you can have in your possession. Potentially you can also have that move with you. Again, it's outside of the banking system. Obviously, you need to know what you're doing. You need to know what you're buying so that you can evaluate the worth of it. But art is something else. Memorabilia. One of the famous ones that most people always talk about are baseball cards, or here in Australia, football cards. So these are, and it can also be of rock stars, it can be a guitar, whatever the case might be. But memorabilia has a lot of value. And again, it's an item that typically you would be able to hold, store, and it's no one's business how much it's worth, or, where you store it, or whether you've got it or not. And again, it's outside of the banking system. Some people get into antiques. It could be furniture, could be other items around the house. But antiques, again, can carry value, can increase in value over time. If you have the space and you have the passion, this is something that you can look into to store some of your wealth, similar to precious metals. Then you've got collectibles, whether that could be coins, could be stamps, could be anything else. Some people, for instance, will create a portfolio of rare watches, as an example. So these are, again, things that are in your possession. They have value. They're a good store of value because they typically will increase as time goes on. So it's not the flashy, fancy, stuff that just comes and goes. These are the traditional things that you would have with regards to watches, and obviously stamps and coins are in a whole different area themselves. But these are, again, things that you hold separately. You hold them in your physical possession, and they're outside of the banking system. Another one that's a favourite of people, but obviously it requires very, very strict discipline, which is wine and spirits. And you can imagine why. Now, I was surprised to find out that over the last couple of years, one of the things that have increased a lot in value, and in particular over COVID, was wine and spirits. And we're talking about, obviously, the high-end stuff where you typically buy it, you leave it in its packaging, and again, it increases in value over time. And it's another very solid place to put your wealth, store your value. And again, it's in your possession. Again, though, you're going to have the appropriate storage facilities and so forth. But it's an item that is outside of the banking system. And then, of course, the one that we've been talking about the most on this podcast is obviously crypto. Crypto, again, is something that you're in possession of it, or you should be. If you're not, get it off the exchanges, put it into your cold storage. Ideally, the only time you should have it in hot wallets is if you're actually doing some transaction with DeFi, because there's a slight more risk in terms of exposure if you're dealing with a hot wallet. So have it in cold wallets, have it in multiple cold wallets, and store it in multiple locations, along with the seed phrases that come with that responsibility. But everything that I've just mentioned operates outside of the banking system. And of course, they don't make any money. That's why they don't like it. In particular with crypto, that's why they've been part of the rubbish that you hear out there as to what's going on with crypto and how risky it is and so forth. If you take the appropriate steps, it's as secure as anything else you can invest in. But the banks, they don't get to make money in it, so of course they don't like it. So if you think about the scenario today, in particular with crypto, you can have a wallet. You can store value on that wallet on your phone or on an appropriate device. You're able to transfer at the speed of light anywhere within the world. You can move that crypto to whoever can receive it with minimal fees and super fast, no different than sending an email. You're able to, in some instances, earn interest on deposited amounts. And if you delve a little bit further, you're then actually able to earn yield on some of those selected amounts of money. So if you think about what does that sound like? Well, it sounds like what a bank account should be doing for you. It should be able to store your money, your salary. It should be allow you to do transfers. And what it hasn't been doing for many, many years is it hasn't been giving you any value. It hasn't been giving you any interest, typically, and you're not making any money on it. So, you can understand why banks, it's a direct competitor to banks. They don't like it. And that's why you're going to get a lot of nonsense, a lot of resistance from banks in being able to even transfer your funds at the moment into crypto exchanges so that you can get out of their system. They don't like it. And I've heard of examples where banks have been difficult with money transfers, even if you were looking to buy gold and silver, because it's leaving their system. So when you understand and you look into how banks are structured, how the whole banking structure is around the world, you'll understand why everything I've just mentioned around precious metals, arts, memorabilia, antiques, collectibles, wine and spirits, and in particular crypto. Well, yeah, of course, they don't get to make any money from that, so why would they like it? And they're going to do everything they can to FUD it. So hopefully that's giving you a wider perspective on what you can do with your wealth, where you can put it. And if you look at very wealthy families, they use everything that I've just mentioned. They spread their wealth right across the board. They don't have it in a particular asset class. They don't have it in particular assets. They spread it across, and they definitely don't have it everything in areas where other people are controlling it or can control it. The other thing I wanted to leave you with this week is if there are any other topics that you'd like me to cover, please ping me either on X or via the website. You can send me an email, or if you're in Snipverse, go there and send me a message if there's particular topics that you want me to cover. Please let me know. Now, last week we talked about the homework being have a look at what spreads and slippage are, and in regards to exchange prices. And if you haven't done it, or if you have done it, what I'd like you to do this week is then go and understand, well, how do these spreads and slippages affect your transaction in determining perhaps which exchange you will use or which exchange you won't use. So go and have a look, and if you haven't done a real transaction, look at doing a pretend transaction and understand how sometimes what might be cheaper on one exchange, by the time you do the fees, you have a look at the spread, you might find that you're actually paying 2 or 3% higher on that platform than on another. So go and have a look at that. Otherwise, take care, and we'll chat again in a week. Cheers. If you found this information helpful and are interested in a more hand-holding approach while navigating this complex industry, please visit cryptobasicscoach.com, that's basics with an S, and book a session. The first 30-minute session is free, and we can get to know each other, talk about what your aims are, what you're looking to do, and how I might be able to possibly help. I've helped people get started, set up exchange accounts, wallets, DeFi platforms, and general knowledge. Look forward to speaking with you. Cheers.